All right, hey everyone, welcome back to Premier Study in Investing. I'm going to be looking at an article today from, again, Fortune magazine. Really finding some great stuff from them, and we're going to be looking at a little article from Warren E. Buffett, the Oracle of Omaha. He's going to be talking about why stocks beat gold and bonds in his estimation. It's going to be really interesting if this is 2012 when this article was written, so you got to think a little bit about the time. But there are a lot of people talking about gold. Inflation hedges and things of this nature. I thought it was really, really interesting article just in general. You can get some insights into him. So let's see what he says. He's going to basically be talking about gold investing, a little bit about Berkshire, some of the problems with having currency-backed assets like bonds, especially is what he's talking about, and some of the problems we can run into with losing money to inflation. So the difference between nominal yield on the bonds versus the real yield after taxes and inflation is taken out. Finally, he's going to jump into his views on gold and what he would like to do with his money that comes through Berkshire, why he's such a big fan of Coca-Cola and some of these other businesses, railroads and things like this. All right, so Fortune says investing is often described as the process of laying out money now in the expectation of receiving more money in the future. At Berkshire Hathaway, ticker BRKA, we take a more demanding approach, defining investing as the transfer to others of purchasing power now with the reasoned expectation of receiving more purchasing power after taxes have been paid on nominal gains in the future. More succinctly, investing is foregoing consumption now in order to have the ability to consume more at a later date. Sounds good so far? From our definition, there flows an important corollary. The riskiness of an investment is not measured by beta, a Wall Street term encompassing volatility and often used in measuring risk, but rather by the probability, the reasoned probability of that investment causing its owner a loss of purchasing power over his contemplated holding period. Assets can fluctuate greatly in price and not be risky as long as they are reasonably certain to deliver increased purchasing power over their holding period. And as we will see, a non-fluctuating asset can be laden with risk. Investment possibilities are both many and varied. There are three major categories, however, and it's important to understand the characteristics of each. So let's survey the field. Investments that are denominated in a given currency include money market funds, bonds, mortgages, bank deposits, and other instruments. Most of these currency-based investments are thought of as safe. In truth, they are among the most dangerous of assets. Their beta may be zero, but their risk is huge. Over the past century, these investments have destroyed the purchasing power of investors in many countries, even as these holders continue to receive timely payments of interest and principal. This ugly result, moreover, will forever recur. Governments determine the ultimate value of money, and systemic forces will sometimes cause them to gravitate to policies that produce inflation. From time to time, such policies spin out of control. Even in the U.S., where the wish for a stable currency is strong, the dollar has fallen a staggering 86% in value since 1965, when I took over management of Berkshire. It takes no less than $7 today to buy what $1 did at that time. Consequently, the tax-free institution would have needed 4.3 interest annually from bond investments over that period simply to maintain its purchasing power. What he said was 4.3 was required. Its managers would have been kidding themselves if they thought of any portion of that interest as quote-unquote income. For tax-paying investors like you and me, the picture has been far worse. During the same 47-year period, continuous rolling of U.S. Treasury bills produced 5.7% annually. That sounds satisfactory. But if an individual investor paid personal taxes at an average rate of 25%, this 5.7% return would have yielded nothing in the way of real income. This investor's visible income tax would have stripped him of 1.4 points of the stated yield, and the invisible inflation tax would have devoured the remaining 4.3 points. It's noteworthy that the implicit inflation quote-unquote tax was more than triple the explicit income tax that our investor probably thought of as his main burden. In God we trust. may be printed on our currency, but the hand that activates our government's printing press has been all too human. High interest rates, of course, can compensate purchasers for the inflation risk they face with currency-based investments, and indeed, rates in the early 1980s did that job nicely. Current rates, however, do not come close to offsetting the purchasing power risk that investors assume. Right now, bonds should come with a warning label. Under today's conditions, therefore, I do not like currency-based investments. Even so, Berkshire holds a significant amount of them, primarily the short-term variety. At Berkshire, the need for ample liquidity occupies center stage and will never be slighted, however inadequate rates may be. Accommodating this need, we primarily hold U.S. Treasury bills, the only investment that can be counted on for liquidity under the most chaotic of economic conditions. Our working level of liquidity is between or around 20 billion. 10 billion is our absolute minimum. Beyond the requirements that liquidity and regulators impose on us, we will purchase currency-related securities only if they offer the possibility of unusual gain, either because of a particular credit is mispriced, as can occur in periodic junk bond debacles, or because rates rise to a level that offer the possibility of realizing substantial capital gains on high-grade bonds when rates fall. Though we've exploited both opportunities in the past and may do so again, we are now 180 degrees removed from such prospects. Today, a wry comment that Wall Streeter Shelby Colum Davis made long ago seems apt. Bonds, promoted as risk-free returns, are now priced to deliver return-free risk. Now, the second major category of investments involves assets that will never produce anything, but that are purchased in the buyer's hopes that someone else, who also knows that the assets will be forever unproductive, will pay more for them in the future. Tulips, of all things, briefly became a favorite of such buyers in the 17th century. This type of investment requires an expanding pool of buyers who, in turn, are enticed because they believe the buying pool will expand still further. Owners are not inspired by what the asset itself can produce. It will remain lifeless forever, but rather by the belief that others will desire it even more avidly in the future. The major asset in this category is gold, currently a huge favorite of investors who fear almost all other assets, especially paper money, of whose value, as noted, they are right to be fearful. Gold, however, has two significant shortcomings, being neither of much use nor procreative. True, gold has some industrial and decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. Meanwhile, if you own 1 ounce of gold for eternity, you will still own 1 ounce at its end. What motivates most gold purchasers is their belief that the rank of the fearful will grow. During the past decade, that belief has proved correct. Beyond that, the rising price has on its own generated additional buying enthusiasm, attracting purchasers who see the rise as validating an investment thesis. As quote-unquote bandwagon investors join the party, they create their own truth. For a while, over the past 15 years, both internet stocks and houses have demonstrated the extraordinary excesses that can be created by combining an initially sensible thesis with well-published rising prices. In these bubbles, an army of originally skeptical investors succumbed to the proof, quote-unquote, the proof delivered by the market, and the pool of buyers, for a time, expanded sufficiently to keep the bandwagon rolling. But bubbles blown large enough inevitably pop. And when the old proverb is confirmed once again, what the wise man does in the beginning, the fool does in the end. Today, the world's gold stock is about 170,000 metric tons. If all this gold were melted together, it would form a cube of about 68 feet per side. Picture it fitting comfortably within a baseball infield. At $1,750 per ounce, gold's price, as I write this, its value would be about 9.6 trillion. Let's call this cube pile A. Now, let's create a pile B, costing an equal amount, 9.6 trillion. For that, we could buy all U.S. cropland, which would be 400 million acres with output of about $200 billion annually, plus 16 ExxonMobils, the world's most profitable company, earning more than 40 billion annually. Now, after these purchases, we would have about 1 trillion left over for just walking around money. No sense feeling strapped after this buying binge. Can you imagine an investor with 9.6 trillion selecting pile A over pile B? Beyond the staggering valuation given the existing stock of gold, current prices make today's annual production of gold command about $160 billion. Buyers, whether jewelers and industrial users, frightened individuals, or speculators, must continually absorb this additional supply to merely maintain an equilibrium at present prices. A century from now, the 400 million acres of farmland will have produced staggering amounts of corn, wheat, cotton, and other crops, and will continue to produce that valuable bounty, whatever the currency may be. ExxonMobil will probably have delivered trillions of dollars in dividends to its owners and will also hold assets worth many more trillions. And remember, you get 16 Exxon companies, not just one. The 170,000 tons of gold will be unchanged in size and still incapable of producing anything. You can follow the cube, but it will not respond. Admittedly, when people a century from now are fearful, it's likely many will still rush to gold. I'm confident, however, that the 9.6 trillion current valuation of pile A will compound over the century at a rate far inferior to that achieved by pile B. Our first two categories enjoy maximum popularity at peaks of fear. He's talking about bonds and then the gold. Terror over economic collapse drives individuals to currency-based assets, most particularly U.S. obligations, and fear of currency collapse fosters movement to sterile assets such as gold. We hear cash is king in late 2008, just when cash should have been deployed rather than held. Similarly, we hear cash is trash in the early 1980s, just when fixed dollar investments were at their most attractive level in memory. On those occasions, investors who required a supportive crowd paid dearly for that comfort. My own preference, and you knew this was coming, is our third category, investment in productive assets, whether businesses, farms, or real estate. Ideally, these assets should have the ability in inflationary times to deliver output that will retain its purchasing power value while requiring a minimum of new capital investment. Farms, real estate, and many businesses such as Coca-Cola, IBM, and our own See's Candy meet that double-barreled test. Certain other companies, think of regulated utilities for example, fail it because inflation places heavy capital requirements on them. To earn more, their owners must invest more. Even so, these investments will remain superior to non-productive or currency-based assets. Whether the currency a century from now is based on gold, seashells, shark teeth, or a piece of paper as today, people will be willing to exchange a couple of minutes of their daily labor for a Coca-Cola or some See's peanut brittle. In the future, the U.S. population will move more goods, consume more food, and require more living space than it does now. People will forever exchange what they produce for what others produce. Our country's businesses will continue to efficiently deliver goods and services wanted by our citizens. Metaphorically, these commercial cows, quote-unquote cows, will live for centuries and give even greater quantities of milk to boot. Their value will be determined not by the medium of exchange, but rather by their capacity to deliver milk. Proceeds from the sale of the milk will compound for the owners of the cows, just as they did during the 20th century when the Dow increased from 66 points to 11,497 points, and also paid loads of dividends as well. Berkshire's goal will be to increase its ownership of first-class businesses. Our first choice will be to own them in their entirety, but we will also be owners by way of holding sizable amounts of marketable securities. I believe that over any extended period of time, this category of investing will prove to be the runaway winner among the three we've examined. Most important, it will be by far the safest. This article was from February 27th, 2012 issue of Fortune magazine. So Hope everyone enjoyed that. Very, very excellent. Thank you, Fortune Magazine. Really, really been impressed with them. And of course, this is very good. Warren Buffett, Why Stocks Beat Gold and Bonds. This is Premier Studying and Investing, and we will definitely see you guys in the next one. Thanks so much.
Oh, Billy, you're so stupid. You should have said I love you infinity plus infinity.